What if I told you that you're already making the most common investment mistake, and it's costing you big time? Most people think investing is just about picking the right stocks, but they're wrong. Here's why I wish I knew this 10 years ago. You're probably thinking, oh no, not another video telling me how to pick stocks. But trust me, this isn't about picking stocks. It's about something much bigger that most investors overlook. It's that one mistake that's draining your financial future before you even realize it. And here's the thing, most people are making it without even knowing. Hello everyone, I'm LoopVest. Now, before you think this is just another investment video, let me tell you why this is different. Think of investing like planting a tree. You can't expect a tree to grow in a day or two, right? But most people treat their investments like instant noodles, expecting instant results. Spoiler, it doesn't work that way. If you're thinking, I'll just buy this stock today and be rich tomorrow, you're setting yourself up for a big disappointment. You think if you buy the hottest stock right now, you'll make quick money. But here's the kicker. Most people who chase after that quick win end up losing more than they ever imagined. You get in, ride the hype for a while, then bam, the stock crashes and you're left holding the bag, thinking, what just happened? So, here's what you should do instead. Invest for the long term. Think of it as planting that tree. Plant it, water it, and let it grow over time. Sure, it might take a while, but when it finally matures, it'll pay off far more than that one hot stock ever could. So don't let your investments be a quick fix. They need time, patience, and proper care. Now that you understand why this mistake is so dangerous, let's talk about the exact steps you can take to avoid it. So what's the number one mistake most investors make? They're chasing quick profits. Let me tell you about Steve. Steve saw all the hype on social media about this hot stock that was about to explode, and he jumped in without thinking twice. He even saw people around him celebrating their big gains. So Steve thought, why not? He bought in, hoping to make a quick buck. Fast forward a few weeks, the stock crashed, and Steve lost almost everything. He ended up regretting his decision, asking himself, why did I listen to that random post I saw on Instagram? But here's the thing. Steve's mistake wasn't about picking the wrong stock. No, his mistake was thinking that investing should be about chasing quick profits. And that's the mistake most people make. Here's what I want you to understand. Stop focusing on quick wins. The most successful investors think long-term. And I'm not talking about waiting 20 years to make money. No, I'm talking about setting up long-term goals that are based on solid investments. And you know what? This brings us to the second point. You need to invest based on fundamentals, not hype. Sure, following trends can sound exciting, but if you're only looking at the latest trending stock without understanding its real value, you're gambling, not investing. You can't expect to win big overnight, but you also can't bail out at the first sign of trouble. Use the market's volatility to your advantage. Let it test your patience. If you want to succeed in this game, learn to ride out the ups and downs instead of reacting impulsively. How many times have you thought, if I just had bought that stock a week ago, I'd be rich now? Trust me, I've been there. I've fallen for that quick profit trap, and it cost me. But here's the truth. Those quick gains are often followed by even quicker losses. Now that you know why chasing short-term gains is a huge mistake, let's dive into how you can actually set yourself up for long-term success. But wait, that's not the only mistake most investors make. Let's talk about the one that could leave you with nothing. Lack of diversification. Let me share a story about Tom. Tom was doing great with his investments. He bought shares in a company that everyone was talking about. The stock was soaring, and Tom felt like a genius. But then, one day, the company had a massive scandal, and the stock plummeted. Tom lost everything. Now imagine if he had spread his investments across different industries or even different asset classes. Instead of having all his money tied to one company, he could have weathered the storm. But because he put all his eggs in one basket, he ended up with nothing. And trust me, this happens a lot more often than you think. So here's the deal. Don't put all your money into one stock or one sector. Diversification is key. When you spread your money across different types of investments, like stocks, bonds, real estate, and even some alternative assets, you lower your risk significantly. It's like having a safety net. If one part of your portfolio goes down, the others can still help keep you afloat. Think about it. You wouldn't put all your money into one lottery ticket, would you? You'd buy a few different tickets, increasing your chances of winning. Well, that's what diversification does for your investments. It's your way of reducing risk and making sure you're not left with nothing if one area crashes. Sounds familiar? You put all your money in one stock and then it crashes. What are you left with? Nothing. But if Tom had diversified, he wouldn't have been left high and dry. Now that you know the importance of diversification, let's look at how to build a solid portfolio that can survive any market condition. And here's the big one that most people overlook: compounding. Let me give you a quick example. Imagine you invest $1,000 today at a 5% return. In 10 years, that $1,000 will have grown to $1,628. But if you leave it for 20 years, that same $1,000 turns into $2,653. And if you let it ride for 30 years, it's over $4,300. Now, I know what you're thinking. $1,000 doesn't seem like much. But the point is, compounding works its magic over time. It's not about the amount you start with, it's about the time you give your money to grow. Here's the key. The earlier you start, the more time your money has to compound. That means if you start investing in your 20s, you're giving yourself a huge advantage. But even if you're starting in your 30s or 40s, it's still not too late. The trick is to set up a long-term plan, make regular contributions, and not get distracted by short-term market movements. Don't wait for the perfect time to start investing. Just begin. I know, you're thinking, I don't have enough money to start investing. But what if I told you that $50 a month could make you a millionaire in 30 years? Yeah, you heard me right. Small, consistent investments add up over time. It's like planting a tree today and watching it grow into something massive years down the line. Now, if you want to understand how to make those investments work for you, then stick around. Let's dive into how you can get the most out of your money, even if you're just starting. Let me recap what we've covered here today. First off, don't chase those quick short-term gains. Patience is key. Second, diversify your investments. Don't put all your eggs in one basket. And finally, don't underestimate the power of compounding. Start now and give your money the time it needs to grow. Now, if this video helped you out, smash that like button. Or don't, but trust me, you'll regret it later. And hey, if you want more simple tips on how to start building wealth, hit that subscribe button too. We're just getting started. All right, now that you've got the basics down, if you're ready to dive even deeper, check out my other video. Trust me, you'll want to see this.